Dundas Global Equity Fund, Q1 2022. Thank you all for your attendance and good morning to our hosts from Edinburgh. My name is Luke McIntosh, Sales Director at Apostle Funds Management, and we're joined today by Neil Sutherland and David Kerr from Dundas, who will provide an update on the fund. Please reserve any questions for the end of the presentation, but feel free to use the online chat function to submit your questions during the presentation, and we'll endeavour to respond after we conclude. Now, just in terms of disclaimer, the information today is confidential in nature. It cannot be shared without the permission of Apostle Funds Management. The information is general in nature and does not take into account personal financial circumstances, needs, or objectives. So with that, I'd like to hand over to Neil and David, and thank you for your time.
Great, thank you very much, Luke, and good morning and good evening from Edinburgh. Thank you very much for taking the time to listen to us this morning. So what we'd like to do, we'd like to just give you a reminder of what we do and why we do it. So we'll skip through that. Hopefully we've met many of you before, and if not, hopefully we'll meet you all again soon in person. Second part, we'll talk through the Q1 and the highlights of that has been a challenging time for us. So as we've seen utilities, energy and real estate, we've seen some of those being the more, and some of the commodity stocks, some of those companies being the best performing in the first quarter. It's been no surprise for us that we have trailed the index in the first few months of this year. And then what we'll do is my colleague David will take you through the quarter in a bit more detail. And one of the other things that we want to highlight is one of our focuses is really on fundamentals and making sure that the fundamentals come through. And then there will be times where valuation will come and go, and David will bring that to life hopefully for you all, and some of the really good dividend numbers that we've seen in 2022. Okay, if we move to the next slide, please. Okay, so I'm going to show you two studies, and these are studies that explain Dundas, hopefully, and carried out by other respected organisations. So the first one is from MSCI, and it was a study that they had performed for the Norwegian Ministry of Finance, so the largest sovereign wealth fund in the world. And what this looked at, they looked at different asset classes. What we're looking at here is equities and what we at Dundas do. And what this shows you in this study is that we're trying to look at the componentry of long-term return and some of the dynamics that happen over shorter periods and longer periods. So if we start on the left-hand side, what you'll see over 1 year periods, then you will get 11% of your return will come from dividend yield, which is effectively the cash that's returned to shareholders. Plus 38% is coming from the dividend growth numbers. And we could actually take the word dividend off that. That's the underlying growth of the business. But 51% actually comes from valuation. So that is the market, whether speculating or looking forward or trying to work out what those shares are actually worth. Now, what we know is that is the most volatile element to total return. But what we see is some of those dynamics of, if you look over 10 years and 20 years, that blue bar starts to reduce. Now, this is very important for us at Dundas because we do have a hyper focus on that maroon bar. So what we're really trying to do is to find growth companies that evidence that through the growing dividend stream. And we'll break that into more detail. If we can move on. Okay, this is a study from Ned Davis Research, and they do some great work looking at the behaviour of dividends and its relationship to total return. And what they look at is companies that have grown their dividend, that have cut their dividend, that pay a dividend, don't pay a dividend, etc., etc. And what they do is equally weight each of those buckets, and they measure the returns. So what this study has shown, we actually spoke to Ned Davis and requested them to see if they could create another part for the data set, which was looking at companies that could grow their dividends for 5 years in a row. So pleased to say that those 5-year growers, so sustainable growers, give the best return, so just over 10%. But the other column next to that is the standard deviation. So you'll notice that that is the lowest. So the best Sharpe ratio comes from that cohort of stocks over the long term. Now, Looking at the bottom of that list, so looking at cutters and non-payers, again, you'll see those as the weaker returns, but what you'll also see is that those are highly volatile. So for us, for Dundas, and summarising those two slides is, what does that mean? We are trying to pick dividend growers and avoid the cutters, holders, etc. And what we're trying to do is we need to hold them for a long time. So we're a buy and hold manager, and we're trying to get the best of those companies. Okay, next slide. Okay, so what we're just showing here is that same breakdown into those three sections, and effectively this is a style map. Now, when you're speaking to investment managers, there is probably one lever that they are trying to pull to get the core part of the return. Now, for us, it's that business growth. So a lot of our analysis, deep within financial analysis, and we do all our own research for all the companies that we look at, and we're trying to find that best dividend growth. Because as we've seen in the other picture, and we've seen from the Ned Davis study, is that's how we believe we'll outperform and beat the market. So you've got business growth, you've got cash return to shareholders. Now, if a manager was looking at that middle one, that would be an income manager. Then the final one is a valuation change, which would be a valuation manager. So the one that we are pulling is business growth, and a particular metrics and focus that we have is around dividend growth. Okay. Next slide. Great, so how have we done? So history of the fund. So you see the fund started 31st August 2012. And what we can see here is the dividend growth for the portfolio has been 10.7. The average yield over the period of running the fund has been 2, and valuation has been a little bit of a headwind for us in getting to a total return. So going back to that MSCI study, that's great. This is what we would have hoped for, is the majority of that return has come from the underlying fundamentals of the business. So actually that is banked profits and earnings that these companies have produced. If you look at the index, 4% for dividend growth, 2.6% dividend yield, and 4.1% for that residual, which is largely valuation. So what does that mean? This, as we're looking at this period, it's almost a decade. And what that is showing is about 40% of the total return has come from valuation. So it's been a decade, not like no other. Every decade is like no other, but there are similarities in there. So what you will see is that is probably a higher valuation rate than was shown up, for example, in the MSCI study over 10-year periods. I'm sure you've all experienced that and seen many of, particularly in the US, some pretty large valuation expansion. Okay, move on one more. Okay, just want to give a wee bit more context, and let's look at the last 5 years within this period. So what does this show? Dividend growth 10.8. So hopefully you get that point that we're pretty consistent around providing that the dividend growth numbers. Average yield is a little bit lower at 1.6. And then you'll see that residual is 3%. So what that's saying is we have benefited a bit from valuation. Now this is to the end of March, to the end of the quarter. So we've benefited a bit from valuation in the last 5 years, but not as much as the index. So still what you're seeing is you're still seeing the core components of our return coming from that dividend growth and dividend yield. So I suppose this is similar to that MSCI study. The longer it goes on, the less the valuation makes a difference. So it still made a difference for us. I don't think we could have been in the market and not got a valuation gain over the last 5 years. So again, pleasing numbers for us. Okay, we move on. I won't dwell on this too much. I suppose the important thing for us when we look at this, we tend to start at the right-hand side and tend to look at the compound numbers as a long-term investor, and those 5-year numbers are pretty important to us as well, because as managers, what we're tending to do when we look at companies is we tend to look over a 5-year period, whether that's looking back and looking forward. Over the 1-year period, you'll see a bit of outperformance, which I suppose if we were to look at some of the headlines, that's a pretty good number considering we are a growth manager and the value index had beaten the growth index over that period. So pleased with that. But obviously the quarter, and David will go into that in more detail, we have lagged the market as those commodity prices have raced up. Okay, move through to the next slide. So looking at those numbers, it's important for us to look at the upside downside capture. Now, this is a period, the last 3 months, where our downside capture has not been so good. We would expect from our returns is the market, maybe a wee bit more, maybe a little bit less on the way up, depending on what's driving that. But on the downside, we would expect those numbers to be proving our worth. So as markets start to fall, typically we do better. I suppose what we're looking at is a quarter, but that's not happened because of the commodity or change in price. Okay, move on one more slide. Okay, firstly, apologies, this is a lot of numbers. What's this showing us? So this is the growth rate in the portfolio. So this is using the trailing 12 months as a guide to helping us look at the next 12 or the next long-term periods. So this has been our guide for that we've used throughout the portfolio, and what this has tended to do is to see how much growth is in the portfolio. So what we're looking at, so this is in relation to that dividend growth number. So there is a connection with this. I'm going to start middle. So we look at our return on equities and we multiply that by our retention rate, and retention rate is 1 less the payout ratio. So that's how much companies are retaining within their own business to reinvest for the future. So what you see is our retention rate is higher. So that means our dividend yield is lower. So effectively what we're saying is we're not the manager looking for dividends today, we're looking for dividends tomorrow. So it's really that growth. So the dividend, we have got lower dividends today, and then we expect that to grow over time. So pleased with those growth rates, and I suppose there's key elements to that. So one of the things is the reinvestment rate that sits behind that. So what you'll find is our CapEx numbers, and as a percentage of revenues and the respend that happens within our firms, is that CapEx spend is around 6%, so it's a little ahead of the index, which is a great number. And what is CapEx? That's more shops, more factories, and basically doing more of what you do today, tomorrow. Okay, so it's an expansion thing. When looking at R&D, we have an 8% reinvestment rate. So if you think 6 from CapEx, 8 from R&D, that's a huge spend. And that's versus only 2% for the market. So 4 times larger within our portfolio. So we see that as key within our company. So what we want our companies to do is to be creating more revenue. So they have to get their sales increasing year on year. Through that cascade, what we would expect to see is hopefully they can turn that into higher profits. But actually what they do with that cash is to hopefully reinvest it back in the business to get that internal compounding working. So where does that manifest? So looking at the breakdown of that R&D, net income as a percentage of sales times asset turnover times financial leverage. Net income as a percentage of sales is another way of saying margin. So effectively our margins, so that reinvestment is protecting those margins, because what that's doing is it's creating new products that are desired, or maybe new efficient ways of doing what you do before. Then what that will do is that in turn will protect the margin, because people are prepared to pay for that. So higher margins times higher turnover. How efficient are you at using your assets? Lower leverage to get our return on equity. Now we would say we're a quality manager, and these metrics really defining that quality. A couple of things to notice, I suppose, in inflationary times, what has been going on. So you would expect inflation to hit that margin number. So as things become more expensive, harder to make profits, so you maybe see a bit of a squeeze on the margins. So looking at these numbers, delighted to say that 2/3 of the portfolio for the first quarter of this year have expanded their margins. Now, part of that reinvestment, that's that reinvestment and that brand value really kicking in. And typically the type of companies that we own are generally leaders in their market or kind of definitely up there. So we believe there's quite a lot of pricing power, which we see evidenced through that margin number. Okay, if we just move on. And David, could I pass to you?
Yeah, great. Thanks, Neil, and good afternoon, everybody. So this slide breaks down the top and bottom stock contributors for the quarter. Obviously, Neil's alluded to the fact it was a difficult quarter for us, so there were actually very few winners for us, sadly. I'll just pick out a couple. Activision Blizzard was quite a high profile. It was our top contributor, and that happened after Microsoft announced its intention to buy the company. The deal's been approved by shareholders, and we're just awaiting final regulatory approval. Also, maybe just touching on American Express, actually benefiting from the world reopening post-COVID, and playing to this theme about fundamentals long term, it announced a 20.9% dividend increase in the quarter. Looking at the negative contributors, what was interesting is the vast majority of our companies that performed poorly during the quarter actually reported strong results and posted significant dividend increases. What we saw was very much a case of valuation unwind in many of these holdings. So, for example, Tecan's a good example, global leader in medical laboratory automation. It increased revenue by 29%, profit by 30%, and its dividend by 22% in the quarter. But as you can see, was one of our poorest contributors. Sysmex stands out. It was the worst performer, both in terms of total return and in terms of attribution. As a quick reminder, Sysmex is the 5th largest player in the global in vitro diagnostics market. What does that mean? It basically is a business that does tests taken on samples taken from blood or tissue from the human body, does it in a laboratory in a machine. Sysmex is a particular niche in hematology and historically has enjoyed very good business growth, classic Japanese business growing overseas, particularly in China. In the quarter, Sysmex was much more impacted by the Buy China government policy, which is impacting the buying behavior of all hospitals. So it's a stock we actually reviewed this week. And whilst China is under pressure, a review highlighted that 75% of the business is still growing nicely. There's a lot of opportunities in that 75%. So that's what we're doing a bit more work on at the moment. Move on to the next slide. This is just graphically showing what Neil alluded to in his comments. This is what happened in the quarter at a sector level. And it really was a reversal of recent market trends, with sectors such as energy, materials, giving very strong positive returns, particularly energy, and sectors which have led the market over the last few years, such as IT, communication services, consumer discretionary, all performing very poorly. And as Neil's alluded to, we're a dividend growth manager, so we don't have any exposure to energy due to focus on dividend growth, not dividend yield. And clearly we do have a big overweight in the IT sector. So we were in the wrong sectors in the quarter. If we move on to the next slide, this is just showing our attribution by sector level. So ignore that title, and you can see that our performance was driven in the quarter by overweights in healthcare, overweights in IT, and having no energy. Okay, move on to the next slide. So what's really interesting for us has been, despite the poor performance in the quarter, the fundamentals of our companies in terms of results announced remain very solid. Neil's shown you some numbers. This is all going to be evidenced by dividend decisions taken around the boardroom table. And what you can see here is that 30 of our 69 companies have declared dividends during the quarter, and all 30 of these companies increased their dividends with an average increase of 22.6%. So that's very, very good news for a dividend growth manager. It's also worth highlighting that despite the poor share price performance, our IT holdings actually increased their dividends by 29.3%, and healthcare companies increased them by 17% during the quarter. So move to the next slide. So this next slide is our report card on the dividend growth history. There are a lot of numbers on this page, but I would focus on 2 rows entitled percentage of holdings increasing DPS, and the average DPS increase in local currency. And what you can see is that the whole period, over 80% of our holdings increased dividends, and that includes the 2020, when obviously COVID was a big impact. And in terms of dividend increases in local currency, the average dividend increase has been over 10% over the period, other than 2020, when the increase was still 9%. And that compares very favorably to the index, where dividends fell by around 17%. So the report card does show that very well. And you can just see the numbers I've referenced on the right-hand side. You can just see those 30 increases and 100% increase, 100% of our holdings increasing dividend per share over that period of time in Q1 2022. If we move to the next slide, you can see it's a blank slide. There was no portfolio turnover in the quarter. We did make some changes last quarter, as you'll know, but portfolio turnover, we are very much buy and hold, as Neil's talked about. So portfolio turnover remains low on the metrics you can see on that page. Clearly, at the moment, and markets are volatile, to say the least, as we saw in the US last night. And clearly, you know, things, we do a lot of work, a lot of sifting. So we have a lot of stocks that we're under review, and we've actually, a lot of shares are coming back to what we call price triggers, which is where we go in, do more work in the company and see if it's worth buying at this reduced share price. And we have made one new purchase during the quarter, the second quarter, and we'll tell you about that next time we speak. Moving to the next slide. So this really just breaks down the portfolio, gives you much more detail on the portfolio. You can see, let's just go through the four parts of it. The top left-hand side breaks it down by market cap exposure. And you can see that 80% of the portfolio lies between the $10 billion and a $500 billion market cap. The bottom left-hand side, you can see the regional exposure of the fund. Now, this is by domicile. It's worth remembering that our businesses tend to be global businesses, so country of listing tends to be less relevant. But you can see by a domicile basis that we continue to remain underweight the US. We've had a long-standing underweight in the US, predominantly due to valuation. Whilst we do still have 58% of the fund in the US, it is still underweight the index. However, the breakdown of our portfolio by sales is very different. It's just over a third by US and just under a third in Europe, UK, and also rest of the world, Asia, LATAM, etc. The top right-hand side gives a top 10. So I'll just go back to that slide. The top right-hand side of that slide is our top 10 holdings. You'll see it's quite a differentiated top 10, but also you'll see that our top 10 only represents just under 23% of the portfolio. So we've got 68 holdings in AGEF fund, and obviously it's very well spread across these 68 holdings, a good diversification. We don't have one or two stocks that are big weightings of the portfolio. You can see it's very well diversified. On the bottom right-hand side, you can see this is our sector exposure. So I alluded to this already, as is Neil, and you can see that we continue to have big overweights in the IT and healthcare sector, and we've got no exposure to energy, real estate, and utilities. And that's been consistent. As Neil said, we very much invest for the long term. There are periods where valuation has an impact, and that's none more so than in the quarter. So if we look at the portfolio on the next slide, so this just gives you much more detail in terms of holdings, market cap, sectors, countries. What I'd just like to draw your attention to, and this is data at the end of March, and obviously it has moved on since that period of time. What you can see is the price earnings over the next 12 months and the trailing dividend yield. Now, what you can see on these numbers is that our price earnings ratio for the next 12 months is only 23.6 times. When I say only, that has come down quite significantly over the quarter, as we've alluded to, this valuation compression that our portfolio has endured. And you can see actually that it's not much above the market level now. And why do you think that's interesting? Well, as Neil's trying to tell you and try and talk through, is that we believe our portfolio is much higher quality than the index. And why do we think that? And that's coming through in the returns, the margins, and also the reinvestment. Our companies have much more ability to reinvest, as Neil's talked about, which we believe is the secret sauce of dividend growth investing. And clearly you can look at the dividend yield. It is a lower yield. It has a lower payout and obviously much faster dividend growth as well, as I've shown you in our report card slide. If we move to the next slide, and this really, Neil, this is just really graphically showing what Neil talked about. Why do we believe our portfolio will grow faster than the index? And why do we believe it is higher quality? And this encapsulates this graphically. Our companies have consistently reinvested more in R&D and CapEx over the period of time you can see in the slide since 2013, averaging roughly 13 to 14% of sales every year on CapEx and R&D, and that compares very favorably to the index of around 8%. And we firmly believe that's one of the main reasons why our companies are able to enjoy higher margins, because of reinvestment, be able to produce products that customers want, and are able to pay a higher price for. So going to the next slide. Okay, and that's our conclusion. So Neil, I'll hand back to you.
Great, thank you. Well, I'll probably back to Luke. And are there any questions that you'd like to cover this morning?
We do. Thank you for that, Neil and Dave. We've got a couple of questions coming through on the chat line there. One says that you mentioned turnover is 13.9%, which is quite low. Can you give us an example of a stock that you've sold and why?
Yeah, well, I mean, we haven't sold any during the quarter. We have bought, we didn't buy one either. If you look at last quarter, so look at Q4 2021, we were quite active, and we did sell some, I guess, what we would refer to businesses that were probably mid-single digit growers. So we actually took the chance to sort of clean up the portfolio and look at names that we weren't that happy about. Reckitt Benckiser would be a good example, a business that we'd held, where we reviewed it and we decided that the growth of the portfolio, the growth of that company wasn't good enough. You're looking at a business that could only grow at 4 to 5%. And the way the margin structure had evolved over a period of time was that the high margins was a very difficult task to both maintain that margin and also reinvest in the business, which meant that really all we're going to get as investors was the top line growth, and basically the dividend would grow in line with the top line. So for us, it didn't provide this, we talk about this 10% hurdle dividend growth or 10% return through growth of the business. It wasn't able to hit that hurdle. So we exited our position, and there were a few positions like that we did in Q4 2021.
Thank you very much. Now we've got another question here. I'm just going to read this. You talked about the portfolio valuation has derated alongside the market while fundamentals remain strong. What is the current forward PE of the market of the portfolio now, and how do we think about where it should be?
Yeah, I think we covered that actually, Luz. So that was 23.6 is a forward PE, which is just a little ahead of the market. Can I just add one other thing just about that, the sale question? Probably just embellish that a little bit further, is to just open up our turnover and what is our turnover. So we did a study. We're quite introspective in the sense that we tend to review a lot of our own behaviour and challenge ourselves to make sure our process is as effective as it can be. Now, one of those things was looking at our early turnover running the fund. And what we found was we were trading. So if you think about what are you trading when you do a transaction within the portfolio, those three buckets that I was showing you before, between dividend growth, between yield and valuation, you're trading that as you sell stocks and buy stocks. Now, what we'd found was we were trimming stocks as stocks ran up. We tend to trim them, and at the bottom we were adding to stocks that had some valuation issues. It's a very natural thing to do, and you feel as though you're adding something to the portfolio. What we proved is essentially it was adding nothing. And actually it was maybe masking lesser decision making. So what we try and do, although we do a little bit of that, by far the majority of our turnover is about new buys and full sales as they come in and out of the portfolio. And what David was talking about, that our sales come really in two forms. Either what David mentioned, that growth rate coming down, or alternatively, valuation coming very, very quickly. So if we've got a big spike in a price, and we've got reasonable growth. As we look at the stocks going forward, say on a 5-year basis, if we've got a growth rate of say 12 and a yield of say 0.5, so you get to 12.5, but we've got a headwind of valuation of say -3 or -4, then what's happening is that's looking, the outlook is looking pretty hard to get past that 10%. So it's just to add a little bit more to what David said. I fully agree with what David said.
Thanks, Neil. That's good. Another question that's come through here. Can you just talk through the reasons for lower dividend yield of the portfolio relative to index, given thesis? Is that due to higher reinvestment in the business via R&D?
Sure, I'll go first, David, and then you can follow on. Yeah, partly that. So it's not just R&D; it is that all that reinvestment, but 100%. So the important thing is that reinvestment back into businesses are the things that will drive those margins and to drive those revenues. So that is vital that companies think like that. So no company can stand still. So if we flipped it the other way, what does high yield look like? So high yield payout ratio is very high, so that retention rate is very low, and we just don't see the growth. So there's a lot of energy companies will look like that. So if we picked Exxon, for example, Exxon has been growing its dividend, albeit rather modestly, for a long time. But that reinvestment rate, their payout ratios were going 50, 60, 70, 80, 90, so, and have been at that high payout ratio for a long time. So what does that mean? I suppose for us, the disappointing thing in some of those organizations is they weren't reinvesting into, say, renewables in the future. They did have options to reinvest. So we would always request the fund. There's a study from the 1960s. I don't know if anyone's heard this, from two chaps called Miller and Modigliani, and they debated, are dividends relevant? And really what a lot of their study was talking about was every CEO should find enough opportunity to reinvest all the profits back into the business. Now, we would go a long way with those chaps. However, we don't think you can reinvest everything every year. That you start getting into vanity projects. Now, David's talked about this before, and that competition for capital within organizations we think is key. So that there's very conscious efforts as to what that reinvestment is made. David, did you add anything?
Yeah, just keeping it simple. I mean, we think about it. So our yield is lower than the index, but we expect our dividends to grow much faster for all the reasons that Neil's talked about. And very simplistically, we're the dividend growth manager. So the dividend manager who's reinvesting profits, capital today, to get more profits tomorrow and more dividends tomorrow. And that's very much what, just think what Neil's talked about with Exxon. They're not investing today for dividends tomorrow. So that's the real differentiator. Our dividend yield is lower, but we're investing more to get faster growth in the index. And it will catch up, or really, if you think about it, over the next 6-7 years, that income received from our portfolio will catch up with that received from the index because of this much faster growth.
Yeah, I think one other thing, Luke, actually, is this avoids cuts. So if your payout ratio is very high, then when tough times come, there's not a lot of wiggle room. So in terms of that dividend cover, we'll struggle a bit, and that's often where the cuts will come from. So when we seen COVID hit, there was a lot of companies cut their dividend, and a lot of those companies were very high payout ratio companies, as we've seen that kicking in.
Okay, well, that's pretty much it for the questions. There's more that will come through later, and we will address those to our audience. But on behalf of Apostle Funds Management, thank you very much, Neil and David, for your time. Thank you to Dundas Global Investors, and thank you to our audience who dialed in today. It's really great to have an update like this quarterly. As mentioned previously, David Storm and myself are out there in the market talking to advisors about the fund every day. And it's also very great to have Dundas visit us in Australia several times a year. So we look forward to doing it again. Thank you for your time. Good morning to you in Scotland, and good afternoon to those of us in Australia. Thank you.
Thank you very much. And thank you to everyone for listening.